Welcome to The Explainer. Today, we're diving into something absolutely fascinating. We are unpacking a deep dive piece of source material, the AdvisorShares annual report from mid-2022, to figure out exactly how data-driven active ETFs actually attempt to tackle massive market volatility. We're going to put a microscope specifically on the AdvisorShares Alpha DNA Equity Sentiment ETF, which you might know better by its ticker, SENT. If you have ever wondered how systematic hedging strategies actually function when the macroeconomic floor falls out, well, you're definitely in the right place. Okay, let's look at our roadmap. We'll start with a volatile market shift, followed by the analyst uncertainty problem, and then dive right into the SENT hedging strategy. From there, we'll cover uncovering hidden demand, analyzing real-world performance, and finally, navigating future ambiguity. All right, part one, a volatile market shift. Noah Hamman, the CEO over at AdvisorShares, really hit the nail on the head in his letter to shareholders. He noted it has been a volatile fiscal year with markets declining into bear market territory. And, the contrast was just staggering. The first half of their fiscal year, late 2021, saw the market moving steadily upward. But then, the first 6 months of 2022, totally different. Much darker story. It was literally a violent transition from a roaring bull market right into the claws of a bear market. So how did we get there? It was essentially a chain reaction. Think of it like global dominoes falling. Back in late 2021, you had a choppy pandemic recovery and factory lockdowns severely jamming up the global supply chain. Then, by early 2022, the Russian war in Ukraine completely shocked energy and commodity markets. The result? By mid-2022, inflation was skyrocketing. To fight this, the Federal Reserve stepped in with aggressive rate hikes. But the real heavyweight in the room, the massive concern, was the Fed's plan to reduce their balance sheet, effectively pulling away the safety net that had driven U.S. markets higher during the pandemic. Which brings us to Section 2, the analyst uncertainty problem. The source report points out a really crucial dynamic here. Rising interest rates put massive price stress on growth stocks. And the reason why is pretty straightforward. When the cost of borrowing goes up, it absolutely hammers sectors with low or negative cash flows. Growth stocks usually trade at higher valuation multiples because people expect big future earnings. But when interest rates rise, the present value of those future earnings just plummets, and that puts immense downward pressure on their stock prices. And this is where things got wild for traditional analysts. Their crystal balls were officially broken. They were practically flying blind, struggling with elevated uncertainty on forward earnings, massive difficulty assessing consumer demand, and totally ambiguous revenue estimates. When inflation is soaring and supply chains are a mess, predicting how much a company will earn next quarter becomes a total guessing game. Human analysts just couldn't model that kind of chaos. Moving on to Section 3, the SENT hedging strategy. The philosophy behind systematic investing is actually really fascinating. The report discusses the SENT ETF, but we can borrow a concept from another strategy in the AdvisorShares family, Dorsey Wright, to frame this. Think of it a bit like filling out a March Madness bracket. Instead of guessing based on gut feelings or panicked news headlines, a systematic strategy uses hard data and relative strength to unemotionally pick the winners. It's all about focusing on the stocks that are mathematically showing the greatest ability to win, completely stripping human panic out of the equation. For SENT specifically, its offensive engine relies on something called digital signal analytics. The definition here is absolutely key. It's a systematic process used to identify arbitrage opportunities by uncovering hidden demand that traditional analysts miss entirely. So when human analysts throw their hands up because they can't forecast earnings, SENT's digital signals are actively, tirelessly scanning the data landscape. It capitalizes on the exact uncertainty that paralyzes traditional stock picking. Now, here's a super interesting reality check regarding SENT's defensive options hedges. In theory, these hedges are built to deliver optimal profits in fast, downward-moving markets. An explosive crash is basically the dream scenario for this defensive setup. However, the actual reality of early 2022 wasn't a fast crash. It was a slow, agonizing downward trend. We're talking 3 distinct months, January, April, and June, grinding out negative 8% returns, which really punished small caps. So while the option hedges did produce profits in the down market, that sluggish grind just wasn't the violent downward volatility the hedges were theoretically optimized for. Okay, Section 4, uncovering hidden demand. Let's break down the highly mechanical steps this ETF takes to generate returns. Step 1, target mid and small cap growth equities, because that's where the fastest growing companies usually live. Step 2, explicitly exploit high market uncertainty. Step 3, use those digital signals to uncover hidden demand. And step 4, because it found the hidden demand that traditional analysts missed, it positions itself perfectly to benefit from surprise earnings outcomes. When a company crushes those gloomy expectations, the stock pops and the strategy wins. All right, Section 5, Analyzing Real-World Performance. When tracking the ETF's net asset value against the broader Russell 3000 index, you can really see it was a rocky ride from its inception in early 2021 through mid-2022. You have a portfolio heavily exposed to mid and small cap equities right during a period when mid and small cap growth were the absolute biggest laggards of the U.S. equity markets. But the cool thing here is how those option hedges functioned. They actually successfully produced profits during the downturn, even while the core small cap growth holdings lagged behind the large cap heavy broader market. To be totally objective, since one-year NAV return as of June 30, 2022 was negative 24.53%. Yeah, that is a tough number to look at, but context is everything here. The report points out that its equity exposures performed directly in line with their specific mid and small cap growth cohorts during that brutal window. Basically, the strategy executed its mandate perfectly in a market environment that was historically hostile to its specific target asset class. Finally, Section 6, Navigating Future Ambiguity. There's this fantastic quote from the report that really sums it all up. The more that analysts struggle to assess demand in any market, the better positioned our portfolio is to outperform. And that is the ultimate takeaway for the Cent strategy. A highly uncertain, ambiguous environment, like when we're facing a looming recession, is not something this strategy fears at all. It's actually the ideal hunting ground for its digital signals, because uncertainty creates the exact arbitrage opportunities it was built to capture. But we do have to keep it real about the ongoing macro risks. Rising interest rate pressures will absolutely continue to influence growth stock prices going forward. Growth stocks with higher multiples inherently have higher earnings beat potential, which is exactly what Cent looks for, but they remain super vulnerable as long as interest rates stay elevated. It's a delicate balancing act between finding those micro-level earnings surprises and navigating the macro-level rate environment. And that leaves us with a final thought to ponder. As traditional financial modeling continues to collide with unprecedented global volatility, how will digital signals uncover the next market surprise? The shift toward data-driven, unemotional investing strategies is accelerating fast, and understanding these mechanics is absolutely key to navigating the chaos. Thanks so much for hanging out for this explainer. Keep crunching the data and stay curious.